Welcome to Law You Should Know. The law affects every aspect of our lives, our home, our jobs, and our recreational activities. Now you can learn about the law and how to protect yourself against the loss of your liberty or property. Learn how to stand up for your rights and seek compensation when you have been wronged. Your host for Law You Should Know is attorney Kenneth J. Landau with the Mineola Law Firm of Shane, Dox, Denisi, and Corker. He's a member of the Committee on Professional Ethics of the Bar Association of Nassau County and counsel to the Nassau Academy of Law. And now, here is your host for Law You Should Know, attorney Kenneth J. Landau.
Hi, this is Ken Landau, and welcome to Law You Should Know. As part of our real estate series, tonight we're covering the tax consequences of owning, buying, and selling real estate. And our guest is Barry C. Levittan, and he's the CPA and with the firm of Rosenblatt, Levittan, Volpus, Getz and Company in New Hyde Park, New York. Barry, welcome to Law You Should Know.
Hi, Ken. Thank you.
I know you're involved in representing many small businesses and individual consumers as well as real estate property owners, but Today I'd like to focus on some of the important tax consequences, be they gains or appreciation or deductions available to property owners and renters and landlords and tenants. So let's start out. When someone is buying property, are there any deductions they can take?
Well, when you're buying a principal residence, one of the biggest deductions that you get up front is points on the mortgage. So if you're taking a mortgage, points are measured as a percentage. 1 point basically is 1% of the mortgage. You usually pay that at the closing, and that's fully deductible in year one when you purchase the property.
And that would be true for a co-op or condo as well?
That's true for a co-op or a condo as well. On top of that, at the closing, there are usually adjustments for real estate taxes. Very often the purchaser is reimbursing the seller for real estate taxes that were paid in advance. That's a deduction that's allowable to the buyer. There's also what's called per diem interest, because when you close in the middle of the month, at the closing you pay interest until the end of that month. That's deductible too. So there are a few things that you have to look for on the closing statement that have become deductible. You should make sure to bring that closing statement to your accountant when you prepare your tax return.
And if you have to move a certain distance for, I don't know if it has to be for a job or for some other reason, are some of those moving expenses deductible?
Moving expenses are deductible if you move in connection with a job change, and the distance from where you used to live to where you moved to is more than 50 miles further than where you used to work. In other words, if you move from Brooklyn to Albany and you work in Manhattan because you got a new job, that's more than 50 miles. You can deduct moving expenses.
And could you deduct your expenses of finding that home if you had to fly to places?
There used to be a lot more deductions with regard to moving expenses. Now it's basically just limited to moving yourself and moving your stuff.
Okay. Now, let's say you're buying a second home, or you might rent it out, or it might be an investment, or you're going to use it as a country house. What tax deductions might be involved when you purchase that property?
If you buy a second home and you strictly use it as a second residence for yourself, you don't rent it, you can deduct those real estate taxes. In fact, you can deduct real estate taxes on as many properties as you own. You can have a primary home on Long Island. You can have a second place in Manhattan, a third place in Florida, and so on. All the real estate taxes are deductible.
And this is certainly true for filing your returns for 2017. Things can always change in Washington.
Well, right.
About some of these deductions.
Right. But as many homes as you own that you use personally, all those real estate taxes are deductible. You can also deduct mortgage interest on one second home. You can deduct mortgage interest on your primary residence and one second home. So if you have 3 homes and all 3 have mortgages, you could deduct, again, the primary and one of the two second homes.
And usually you're paying that interest up front in the early years of a mortgage.
Well, the mortgage interest is front loaded, but I should say that mortgage interest is limited. You can only deduct the interest on $1 million worth of mortgages. So let's say you have a primary residence that has an $800,000 mortgage and a second home that has a $600,000 mortgage. Your total indebtedness is $1.4 million. You can only deduct up the interest on up to $1 million. So you have to allocate 10/14ths of that mortgage interest.
And what if the second home is an investment property, or you rent it out part of the year? Does that change?
Well, yeah, that changed a little bit. I just wanted to add one more thing on that mortgage interest. On top of that $1 million, you can also deduct the interest on a home equity loan up to $100,000. So you have $1 million worth of mortgage and $100,000 worth of home equity indebtedness that you can deduct the interest on.
So it's good to know, even if you just need to get a home equity loan, and that interest is deductible.
Up to $100,000 of indebtedness, whatever the interest rate on $100,000 of indebtedness is.
Okay. Let's say you do rent out your property part or all the time. What kind of deductions can you take?
Okay. So if you have a second home and you rent it for less than 14 days, that rent income is completely tax-free. You don't have to report that income. You don't have to pay tax on that income. What's actually happened several times with clients of mine is they have a home and for whatever reason, a movie wants to use that home for filming. So they get what's called a location fee, but it's basically rent. And if that's used for 3 days, 4 days, that's completely excludable because it's under 14 days. And again, you're allowed to rent your second home or any home for up to 14 days, and that income is tax free.
And regardless of the income,
regardless of the amount
you could represent it. You could rent it the high weekends or the high weeks. The most popular ones.
Right.
And
under 14 days, it's not even taxable.
Okay, and if you, in terms of expenses for that second home, if you somehow are going to rent it out more than that, at some point, does it become like a little business?
Well, what ends up happening is there are a whole special set of rules. They call it the vacation home limitations. So if you have a second home and you use it personally part of the time and you rent it part of the time, okay, you're able to take when you use a home as a personal residence, the only things that are deductible are interest and real estate taxes. When you own a rental property, other business expenses become deductible: insurance, repairs and maintenance, landscaping, things like that are not deductible for a personal residence.
And what about improvements?
Well, improvements would be, again, repairs, all those kind of things.
Does it have to have a certain ratio of when you use it or when you rent it out?
It does, because you can't create a loss. You can use those type of expenses, which again wouldn't otherwise be deductible, utilities, insurance, repairs, to the extent that you have rental income. You can't make a loss out of it, but you can at least use those expenses to the extent that you have income.
This is when you live there part of the time.
This is when it's a part rental and a part personal.
If you don't live there, you can have a loss on it.
Well, if it's strictly a rental property, you don't use it personally at all. Now you have, in addition to things like utilities and repairs and maintenance, insurance, and so on, not only are those deductible against the rental income, but now you have what's called depreciation. Okay, so depreciation is when you purchase a property, you can't write off the cost of the property, but you get to depreciate that over a period of years. The period of years for residential property happens to be 27 and a half years.
And also, if the property goes underwater, are you better off than if you owned it and it goes underwater?
Well, let's just go back to the depreciation for 1 second.
Okay.
So again, you buy a second home and you pay $275,000. You get to depreciate that over 27 and a half years. That's a $10,000 a year depreciation deduction on top of the utilities, the insurance, and so on, all deductible against the rental income. I just want to say, depending on what your income is, that if you create a loss from the rental, if those expenses exceed the rental income, those losses are deductible. But if your income is above $150,000, you can't take the deduction. If it's below $100,000, you could take the full deduction. If it's between $100,000 and $150,000, that loss, it phases out. You only get to take part of that loss.
Okay. If you own commercial, if you own a store or let's say a business, is the deduction somewhat similar?
It's the same, again, whether you rent a residence or you rent a store or a business property. And again, you're in the a rent, it's considered a business, and the same deductions are allowable, depreciation, repairs, and so on. And whether or not you can take those losses depends upon your income level.
Okay. And what about in terms of record keeping for the home purchaser, for the home seller, for the home owner who rents it out? What kind of record should you keep, and how long should you save them for?
Okay, so let's first just address that as far as a personal residence goes. A personal residence, you want to keep track of the purchase price of the house, the closing costs, when you bought it, the legal fee, title costs, and so on. You want to keep track of all the improvements you made, not repairs, not painting, not fixing a broken window, but putting on a new roof, adding a room, remodeling a kitchen, putting on a patio, those type of things. All those things increase your cost so that when you sell a house, even if you bought the house, like I know I bought my house over 30 years ago, I paid a little over $100,000 for it. I've spent more than that on improvements over those 30 years. So when I sell it, my cost is no longer $100,000. It's $200 and whatever thousand, because I get to take into account all those improvements that I put in, which will reduce my gain when I sell it.
And that's also going to be true on a commercial property or an investment property?
Well, on a commercial or an investment property, because it's considered a business property, those improvements over the years you're going to depreciate. In a personal residence, you can't depreciate them because it's not a business. It simply adds to the cost. With a rental property, you have to keep track of those improvements because they're going to get depreciated. You're going to get tax deductions as you go along. Unlike on a residence, you're only going to get that back when you sell the residence.
And so for those receipts and proof of improvements, you should really save those, certainly while you're in the premises.
You absolutely.
And probably for some point after that, just to prove the basis.
Right. And the best type of documentation are, bills from the contractors and so on. And the IRS happens to like cancel checks. Not only do they want to see the invoice, but they want to see that you paid it, because it's very easy for anybody to make up an invoice.
And especially with your funds.
Right.
And contracts, whatever you have, paid receipts.
Right.
Okay, we're going to take a short break now. When we return, we'll continue our discussion of the tax consequences of owning, buying, or selling real estate, and we'll focus on also the tax consequences when you sell property. My guest today is Barry Levittan. He's a CPA, and with the firm of Rosenblatt, Levittan, Vulpes, Getz and Company in New Hyde Park, Long Island, and you're listening to 90.3, the voice of Nassau Community College, and also over the internet at ncc.edu/WHPC. We'll be back in a moment.
This program is brought to you by Nassau Community College, which offers a paralegal studies program. Students can major in paralegal studies while earning their associate's degree, or earn a paralegal certificate if they already have a college degree. These programs can even help you start a second career as a paralegal. It's a program for anyone who wants to work in a law office assisting lawyers, the government, or a position in an insurance company. More information about full-time, part-time, days, evenings, weekends, or online courses is available by calling 516-572-7774 or by email at paralegal@ncc.edu.
This portion of programming on WHPC is brought to you on behalf of the Nassau County Bar Association, helping both the public and lawyers since 1899. They are the largest suburban bar association in the country. The Nassau County Bar Association offers clinics where you can meet privately with an attorney to prevent or solve legal problems involving Hurricane Sandy, foreclosure, wills, or elder law. Speakers on almost any legal legal topic are also available to schools or community groups. They can also help lawyers advance their legal careers and offer a place to network. Learn more about the Nassau County Bar Association by calling 516-747-4070 or visit nassaubar.org.